You blamed yourself for that trade. The level held, the breakout confirmed. Everything you were taught to look for was there, so you entered. Then price reversed against you in minutes. You called it manipulation. You called it bad luck. But the market wasn't being irrational. It was being precise. It was solving a logistics problem and you were the solution. By the end of this video, you will understand why the market cannot move randomly, why large participants can't simply enter whenever they choose, and why price is structurally drawn toward specific locations before major moves happen at all. The breakout that trapped you wasn't a mistake in your analysis. It was a necessary component of how large positions get filled. Stay with me. I am Bilal, the disciplined trader. This is episode 11 of the Operator SMC series. Every episode here builds one thing: casual understanding, not pattern recognition. I didn't learn this from a course promising secret institutional signals. I learned it the slow way, losing to the same breakout 4 times before I stopped asking why the market did this to me and started asking what problem it was actually solving. What follows is that answer. Here is the experience most developing traders share. They study a level, they watch the compression build underneath it. The breakout feels inevitable. Then it happens. A large candle closes above the high, volume spikes. Every trader watching that chart reaches the same conclusion at once. This is the move, so they enter. Breakout traders go long, short sellers panic and cover. Emotional certainty peaks at the exact same movement of thousands of traders across thousands of screens. And then, within minutes, price collapses back through the level. The breakout fails. The traders who entered long are trapped underwater. They stop sitting just below an entry they were confident about. Their focused exit accelerated the move lower, and from the breakage of that failed breakout, a real move begins in the opposite direction: clean, efficient, sustained. And the trader who did everything right by the rules they were taught is left asking the same question every trader asks after this: why does this keep happening? Not occasionally, repeatedly. Same type of level, same emotional setup, same results. The answer isn't that you're unlucky. The answer is that you were taught to read the chart, but never taught what the chart is actually processing. Behind every candle, behind every breakout, behind every violent reversal, there is a mechanical process happening that has nothing to do with patterns and everything to do with a problem large participants must solve before they can move price efficiently. That problem is liquidity. I remember the first time I understood the market wasn't random, it was mechanical. Stopped out on the same breakout 4 times in 2 weeks. Same setup, same result. Here is what most traders believe about why the market moves. Price moves because of momentum, because of news, because buying and selling pressure builds organically until one side wins. And when the market reverses aggressively after a breakout, they believe something went wrong, that it was irrational, that manipulation happened for the purpose of taking their money specifically. Both beliefs are incomplete to the point of being dangerous. And here is the specific habit underneath the belief. It isn't stupidity, it's a cognitive shortcut. You saw the candle close that was visible. The reason it closed, the liquidity need behind it was invisible. So the mind does what it always does with an outcome. It assigns causations to whatever was visible and calls whatever it couldn't see manipulation. Traders believe the market moves first and liquidity appears as a consequence. Operators understand that liquidity availability often determines where the market can move efficiently, and price frequently reaches liquidity before it can move anywhere else. That reverses the entire causal chain you've been using to read charts. And here is the deeper truth trading education rarely reaches. Institutions do not primarily care about your stop loss. They care about executable volume. Your stop matters only because when it triggers, it becomes a market order, and market orders are the executable flow large participants need to fill size without destroying their own entry price. You were not hunted, you were useful, and understanding the difference between those two things is the shift that separates a trader who reads patterns from an operator who reads mechanics. In a moment, I'll show you exactly why large participants can't simply enter the market whenever they choose, and why that execution problem is the mechanical engine behind almost every liquidity event you've ever seen on your chart. Here is the fact: everything else in this video depends on institutional size cannot enter or exit a position without its own volume moving price against itself. That single constant is the entire reason liquidity has to be engineered before large execution can happen at all. A retail trader wants to buy. They click the button, the order fills instantly. Price barely moves. A large institution wants to build a significant position in the same market. They can't do the same thing. If a hedge fund market buys enormous size, their own buying moves price upward before the order fills. The first portion fills at one piece. The next fills higher. The next higher is still slippage is catastrophic. The intent is visible. Other participants front run the move. So institutions face a problem retail traders never think about. They need other peoples to take the other side, not a few. Enough opposing order flow concentrated in one location at one movement to absorb a position that would otherwise move price against itself while filling. This is the birth of engineered liquidity, not manipulation for the purpose of taking retail money. Execution logistics. The structural requirement that large size needs dense opposing flow before it can transact efficiently. And where does dense opposing flow reliably appear? Exactly where human beings predictably cluster their behavior. Obvious levels, equal highs, equal lows, the places where thousands of traders independently make the same decision at the same time. That clustering isn't a weakness in retail traders. It's a structural feature of how humans process uncertainty. When uncertainty humans seek the obvious levels attract obvious behavior. Obvious behavior concentrates executable order flow. That concentrated order flow is liquidity, and liquidity is the infrastructure that allows large execution to occur. Now let me make this physical on a chart. Price tests a level once and rejects. It tests the same level a second time and rejects again. Now it's visible to every trader. Watching, validate it twice. Carrying weight, a single test never creates. Short seller plays stop just above those equal highs because that's the obvious invalidation point. Breakout traders place entries just above them because a confirmed break of a tested level signals continuation to them. Both groups independently choose the same location for completely logical reasons. A dense concentration of resting orders sits just above an obvious levels. Short stops that become buy market orders when triggered, breakout entries that become buy market orders when reached, thousands of orders at the same location, created by thousands of traders making the same rational decision independently. That's a liquidity pool. Not because a line on a chart is magical, because human behavior is predictable under certainty, and predictable behavior creates predictable order concentration. Now watch what happens when price approaches those equal highs. Anticipation builds. Breakout traders feels the urgency of the triggering approaching. Short traders feels their stops getting closer. Then price breaks through simultaneously. Short stops trigger into buy market orders, breakout traders enter and add more. FOMO buyers pile in behind them in seconds. A massive concentration of buy side flow hits the market at once. That concentrated flow, deposited by predictable human behavior at a predictable location, becomes the sell side liquidity a large participants needed to distribute inventory, build on a short, or exit a long efficiently. The same candle that felt like a breakout confirmation to the retail trader was an execution opportunity for the institutional participants. Same candle, same level, same movement, completely different reality. Equal lows work identically. In reverse, same behavioral clustering on the sell side when price sweeps through, long stops trigger as sell orders. Breakout shorts add more. Panic sellers accelerate the flow. That concentrated sell side liquidity becomes buy side execution opportunity. The level was never support or resistance in the way most traders understand it. It was a behavioral anchor that created predictable order concentration, and price moved there not to because of the line, but because of the executable flow human behavior had deposited around it. In a moment, I want to show you the complete sequence visually. The loop connecting human behavior to liquidity to institutional execution and back to human behavior again. Once you see this loop, you stop seeing random price movement. You start seeing something that was there the entire time. Picture this on a chart. Price has tested the same high twice, rejected both times. Obvious to every trader watching underneath the surface. Two groups build positions around those equal highs. Short sellers with stop just above, breakout traders waiting for the level to break. Both acting rationally, both creating the same concentration of orders without knowing they are doing it together. Price pushes toward the highs again. Candles accelerate, volume increases, anticipation is physical. Then the high breaks. Short stops trigger, breakout interest fire, FOMO buyers chase. A surge of buy-side orders floods in simultaneously. The candle closes above the highs with aggression. Every single points to continuation. But watch what price does next. It hesitates. The flow through real expansion would show the defended pullback, value building above the breakout doesn't arrive. Price rotates back below the high, then a displacement. Candle lower with a completely different character than the spike before it. Efficient, committed, accepted. The breakout traders who entered long are trapped. Their stops sit below their entries and price is heading toward them. Their forced exit add sell side fuel. The short sellers who covered in panic are now long at the worst possible location. Their liquidations accelerate the downside, and the large participant who needed sell side liquidity to distribute inventory found it exactly where human behavior deposited it, above the equal highs at the location that was obvious to everyone. Precisely because it was obvious to everyone, the market was not random, it was precise. It moved exactly where the logistics required, and the emotional certainty of thousands of traders was the infrastructure that made the move possible. The market was never moving randomly, it was solving a logistics problem, and you were the solution. Every time you placed a stop at the obvious location, you were depositing liquidity where execution required it. Every time you entered a breakout after confirmation, you were providing the opposing flow large positions needed to fill efficiently. Every time you felt the emotional certainty the move was finally real, you were experiencing exactly the psychological state that makes human behavior predictable enough to be useful. This is not a reason to feel like a victim. This is a reason to change what you see when you look at a chart. Because the trader who understands this stop asking why did the market reverse against me and starts asking where is human behavior predictably depositing executable flow right now. And what does that tell me about where price may need to move before the real campaign can begin? That question is not more complicated than what you were asking before. It is more accurate. Carry that question onto the chart, and here is what starts to change the movement you do. 3 mistakes that prevent this from being installed. Mistake 1. Converting liquidity awareness into directional prediction. After learning that equal highs creates liquidity pools, most traders immediately convert that into prediction. They see an equal high and decide price will sweep it before going higher and short in anticipation. Liquidity awareness improves observation. It doesn't create certainty about specific movements. The operator doesn't ask, will price sweep this level? They ask, if price reaches this level, what concentrated flow exists there? And what does the post-sweep behavior tell me about where the campaign is heading? That question is observational, not predictive. And the difference determines whether you are reading the market or betting on it. Mistake 2. Understanding the concept without changing stop placement. Most traders receive this intellectually, then keep placing stops at the most obvious invalidation point and experience the same sweep repeatedly. Understanding why sweeps occur doesn't protect capital. Changing where stops go does. A stop placed at a non-obvious location inside the liquidity rather than just beyond it doesn't deposit the same predictable flow. Mistake 3. Seeing institutions behind every candle. After learning this, many traders becomes convinced every sweep is deliberate, every reversal engineered. that destroys objectivity. Institutional execution logic explains recurring structural tendencies. It doesn't explain every movement. Not every sweep was engineered. The operator stays humble. Paranoia converts observation into confirmation seeking, and confirmation seeking produces the same result as pattern addiction, just with a more sophisticated story about why the losses make sense. Before you look for entries next session, spend 15 minutes doing one thing. Mark every equal high and equal low on your chart. For each one, ask 3 questions. Who's sitting with stops just beyond this level? What type of trader placed orders here and why? And what concentrated flow would be created if price triggered them? Don't predict whether price will reach those levels yet, just map the behavioral infrastructure. Then watch your session unfold. Watch whether the flow deposited there becomes fuel for continuation or fuel for reversal. You are not trading this yet. You are building a different read, and the read has to come before the trade. In the video ahead, we go deeper into each liquidity type, where it forms, how it builds, how operators read it before the collection occurs rather than after. But before that, the market is not chaotic, it is logistical. The chart has been telling you this the entire time. You were just reading the wrong language. Every episode compounds into the next. Stay on this channel.